In the summer of 2019, one company stood at the edge of Wall Street, ready to become one of the largest IPOs of the decade. Its offices were filled with neon slogans, kombucha taps, and a belief that work itself had been reinvented. Then, almost overnight, the numbers were revealed. The valuation imploded. The IPO vanished, and a company once worth $47 billion was suddenly fighting to survive. This is the rise and near collapse of WeWork and how modern finance turned vision into illusion. To understand WeWork, you have to start with the world that created it. After the 2008 global financial crisis, central banks around the world slashed interest rates. Money became cheap. Investors, desperate for returns, began pouring capital into riskier assets. Technology startups became the new frontier, not just for innovation, but for yield. This era rewarded growth over profit. Companies were no longer judged on earnings, but on scale, disruption, and narrative. As long as user numbers grew and expansion accelerated, losses were tolerated. Real estate, traditionally slow and conservative, was not part of this narrative. But WeWork would change that, at least in theory. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey. Neumann was charismatic, ambitious, and unconventional. McKelvey was an architect with a background in design. Their idea was born from a simple observation. Small companies and freelancers needed flexible office space, not long-term leases. The initial concept was practical. Lease large office spaces, renovate them, rent desks and small offices on flexible terms, build community, offer speed and convenience. In its earliest form, WeWork was not revolutionary. Variations of shared office space had existed for decades, but timing mattered, and so did storytelling. Very early, WeWork reframed its identity. It was not a real estate company, executives said. It was a technology platform, a social network for work, a physical operating system for human collaboration. This distinction mattered because technology companies receive far higher valuations than property companies. Tech scales infinitely. Real estate does not. WeWork adopted language that reflected this shift. Members were not tenants. They were a community. Offices were not leased. They were activated. Losses were reframed as investment and growth. The story worked. Investors listened. WeWork expanded aggressively. The company signed long-term leases, often 10 to 15 years, in premium urban locations. It poured money into renovations, branding, and amenities. Then it sold access on short-term memberships, sometimes month to month. This model carried inherent risk. Revenue was flexible. Costs were fixed. But as long as demand grew, the risk remained hidden. And demand did grow at first. Startups, freelancers, and even large corporations were attracted by flexibility and aesthetics. Offices filled quickly in major cities like New York, London, and San Francisco. With every new location, WeWork's footprint expanded, and so did its burn rate. The turning point in WeWork's rise came with SoftBank. In 2017, Japan-based conglomerate SoftBank, led by Masayoshi Son, invested billions through its Vision Fund. Son believed that markets should be dominated quickly, even at the cost of massive losses. SoftBank's capital changed everything. WeWork accelerated expansion beyond demand. Entire buildings were leased before occupancy was proven. International markets were entered simultaneously. Side ventures launched. WeLive, WeGrow, WeBank. The logic was scale first, profit later, or never. By 2018, WeWork was losing money faster than almost any private company in history. Despite the losses, valuations climbed. Private funding rounds pushed WeWork's valuation from $10 billion to $20 billion, and eventually $47 billion by early 2019. These valuations were based on future expectations, not current performance. Metrics emphasized revenue growth and adjusted EBITDA, excluding key expenses. At the same time, Adam Neumann consolidated power. He held shares with 20 times the voting power of regular stock. The board was filled with allies. Oversight weakened. WeWork began to resemble less a company and more a belief system. Internally, warning signs were growing. Losses exceeded $1.9 billion in 2018 alone. Cash burn accelerated. Some locations struggled to fill desks, yet expansion continued. Corporate governance issues multiplied. Neumann personally owned buildings that WeWork leased. He borrowed money from the company. He sold personal shares while encouraging employees to believe in the long-term vision. Still, as long as private capital flowed, none of this stopped the machine. The real test would come with public scrutiny. In August 2019, WeWork filed for its initial public offering. The S-1 filing revealed everything. Investors saw enormous losses, vague risk disclosures, and language that sounded more like a manifesto than a financial document. The word community appeared hundreds of times. Profit appeared rarely. More importantly, the filing confirmed what critics suspected. WeWork was fundamentally a leveraged real estate company, not a technology platform. Public markets reacted swiftly. Analysts began cutting estimates. $47 billion fell to $20 billion, then to $15, then to under $10 billion. Some investors suggested valuations closer to $5 billion. Demand for IPO shares evaporated. Institutional investors declined meetings. Confidence collapsed. Within weeks, the IPO was postponed. Cash levels dropped dangerously low. Without new funding, WeWork risked insolvency. The narrative that once drove growth now accelerated collapse. Pressure mounted on Adam Neumann. Investors demanded change. SoftBank intervened. Governance failures could no longer be ignored. In September 2019, Neumann resigned as CEO. The founder, who symbolized WeWork's rise, now represented its excesses. The IPO was officially canceled. WeWork was running out of money. SoftBank stepped in with a rescue package worth over $9 billion. It took control of the company, replaced leadership, and stabilized operations. Its bailout valued WeWork at roughly $8 billion, an 80% collapse from its peak. Employees were laid off. Offices closed. K's survival replaced expansion. Early employees saw stock options become nearly worthless. Late-stage investors absorbed massive losses. Adam Neumann exited with over $1 billion in compensation, loans, and stock sales. Public markets never participated, but learned the lesson. WeWork changed how investors viewed startups. The phrase WeWork moment became shorthand for inflated valuation detached from fundamentals. Corporate governance returned to focus. Founder control faced scrutiny. Profitability regained relevance. Cheap money had hidden risk. Transparency exposed it. WeWork was not a fraud. The offices were real. Its demand existed. The valuation was built on a story that ignored structural risk. Growth without discipline is fragile. Narrative without numbers is temporary. In finance, belief can move markets, but only reality decides how long they last.